this time round, I'll come to talk about China and Hong Kong, the market outlook in 2015. I think it's just the beginning of the year, and China has gone up so much last year. So what should our investment strategy this year be regarding China and Hong Kong? This is the disclaimer I need to show. These are the key topics I'll cover today. Will China Asia continue to rally amid the economic slowdown? I think some investors are worried about the economic slowdown in China, whether it will hinder or dampen the rally, or the rally last year was just a flash of the pan thing. And as Tom mentioned just now, Shanghai Hong Kong Stock Connect now is reaching its 3 months anniversary after the launch. So what has it achieved and what's next? And what investment opportunities I think is most important are available there for us. And our target, I'll share with you our target for the indexes, Shanghai Composite Index and also the Hang Seng Index. And I remember I recommended this Hong Kong EX last 2 times to you. Now it is trading at around 170, slightly below 180. So what's our view on Hong Kong EX? How much upside there is? And last 2 times I remember I didn't talk too much about Macau, because I have the sense that the Macau gaming industry will be entering a rather difficult environment. So there's no point talking about Macau when the timing is not correct. But this time around, I would revisit the Macau gaming stocks, pondering whether the best days are over or the worst is over. I think it's like half full and half empty. It depends on how you look at it. Okay. Let's have a look at the Shanghai Composite Index. Wow, I always have this frustration, you know. I came to Singapore very often, 3-4 times a year, and every time I talk about China, you remember I always emphasize that China is very cheap, cheapest among many other markets, trading at single-digit PE, price to earnings ratio. But the frustration is, despite being so cheap, it remains cheap, continues to be cheap, and shows no signs of movement. But finally, last year, in the second half, you notice the China market woke up finally, rallying from around 2,000 to 3,400. So year on year, it was up 52.9%. Now, this year, whether the rally will continue, let's have some snapshot, some feel about the economy, how the economy is faring. I think we do admit that the China's economy is slowing down. If you look at the GDP, it grew by only 7.4% last year, slightly below the official target. Yet, some economic growth targets are being achieved last year, so it was actually not that bad. The economic growth target set by the government was 7.5%, but subsequently they accept that. I mean, they're not looking at an absolute figure. They emphasize that it's a range. It is within an acceptable range, and the range is between 7% to 7.5%. So if it's within this range, it's still acceptable. So the final growth rate was very close to the full year economic growth target of around 7.5%. I think sometimes when people look at China, you look at the decline, because China's economy used to grow very fast, very rapidly, above 10%. So over the years, I think it's natural for the growth rate to decelerate. You can't expect every year growing at 10%. That would lead to a bust, right? So by 7.4%, actually China's economy is much stronger than many other economies. Even India grows at only 5%, ASEAN around 4 to 5%. So China is not bad. It's only the worry that there's a hard landing, it cannot be sustainable. On the inflation side, actually China has achieved, I think, quite impressive, because the CPI, once it went up to 5-6%, the CPI, so were very worrying 2-3 years ago. But last year, the full year CPI increased by only by a moderate 2%, much lower than the government's target of 3.5%. I think this achievement is very important because now China's economy is slowing down. So what the central bank can do during, an economic slowdown is to cut interest rates or to ease, to stimulate the economy. But if inflation is still very high, it would become a major obstacle for the central bank. So China, if you look at the CPI, only 2%. That means if the economy slows down further, the central bank has room to maneuver. It will not be hindered by inflation. It can have the room to cut interest rates and implement other easing measures. And then China created 13.22 million urban jobs in 2014. That's also quite impressive because the government's target was only 10 million, so they have exceeded the target of job creation. For China's economy continuing to grow, because later I will show you China, how many births a year? Guess. China, how many babies were given birth each year? So if with the growth in the population, if you don't have the job growth at the same time, it will be a problem for China's economy. So last year, China created 13.22 million urban jobs, and the survey unemployment rate remained stable at about 5.1%. So in many other economies like the EU, European Union, high unemployment, high inflation, but China, I think overall is quite, the economy is quite healthy. It's only that the pace, the rate of the growth rate is slowing down. Okay. Industrial output slows down to 8.3%, but over last year it was up 8.3% year on year. You notice here a pickup in the fourth quarter because the Central Bank of China, PBOC, the People's Bank of China, started to reduce interest rates in November last year. So this was the first time in 2 years since 2012 that the central bank started reducing interest rates. And 1 month after reducing interest rates in December last year, the PBOC cut another rate, that is the RRR rate, the reserve requirement ratio. Reserve requirement ratio means the deposit that the commercial banks have to put with the central bank that they cannot lend out. So now the RRR, the reserve requirement ratio in China, wow, I think it's the highest in the world. It stood at 20% before the cut. That means for every $100 deposit they take from the client, they have to put $20 with the central bank that they cannot lend out. So by keeping the RRR at a very rather high level, the PBOC, the central bank, control lending of the bank. Now, last year they cut it to 19.5%, a 0.550 basis point cut. So after the rate cut and also the RRR cut, we noticed that some of the economic indicators are showing signs of picking up. Here I have not shown 2-3 days ago the HSBC and market. They have released the latest January PMI, Purchasing Manager Index of China. So it has risen about 50 again, 50.1, higher than the expected 49.5. For the PMI, there are two PMI I mentioned last time, every time. One released by HSBC and market, the other one by the Chinese government. That is the official PMI. So 50 is the threshold. Anything above 50 means the economy, the manufacturing sector is still expanding. Below 50 means it's a contraction. So January is quite encouraging because the HSBC PMI rose about 50 again, 50.1. Okay. As you may be aware, GDP, the gross domestic product, is comprised of 3 components, namely fixed asset investment, exports, and domestic consumption. So whether the GDP growth is determined by how these 3 components fare. China, I think the slowdown in the economic growth is attributable to three factors. Fixed asset investment has slowed down quite substantially. You see, it was only up 15.7% last year, but that may not be a bad thing because China, one of the worrying things is there's too much investment, especially in property investment. So people are concerned, are worried about a housing boom, housing crisis. So a slowdown is actually maybe a blessing in disguise. It may not necessarily be a bad thing. Fixed asset investment, we can clearly see that it's dragged down by property investment. Property investment, which is the main driver of the economy, rose 10.5% in 2014, which is the slowest pace since the January-July period of 2009. Because the property sales are declining. So with a weakening property market, property investment also slows down. Newly started property construction fell 10.7% in 2014. Housing sales decreased by 7.6% in floor area and 6.3% in value. But one things make you feel comfortable is the decline in value is less than the decline in floor area. That means the property prices do not drop as much. And land acquisition is very much affected by the housing sales. Land acquisition by property developers decreased by 14% to 233 million square meters. And by land acquisition, I think the Chinese government are very much concerned about land acquisition because it affects the finance of the provincial government. A lot of for the provincial government, the revenue comes from not from tax, because in China, a lot of tax evasion. So the revenue comes from the sale of land. If land acquisition slows down, it may cause problem to the financial position of the provincial government. That's why you see last year they started in the fourth quarter. China started relaxing the restrictions on the property market, which I'll talk later. Floor space of unsold new homes. This is quite a concern. Floor space of unsold new homes nationwide increased 26.1% to 620 million square meters. So you read reports about the ghost towns. I think there's some truth in it because the inventory of unsold the stock has been rising very rapidly. So our view towards the property sector, 内房股, is at the moment is neutral. Our view is neutral because on the one hand you see relaxation, so the condition is now more favorable to the property developers because all the restrictions have been relaxed, and on the other hand you have rate cuts by the central bank and more rate cuts expected. So these will favor the property developers. But on the other hand, the unsold stock is still at a very high level. We believe that it will take time for the market to digest all the unsold stock. So prices may remain at a slump in the short term until the inventory have been depleted. So it will take time. So still no need to rush into property developers. At the moment, our rating for Chinese property developer is neutral. Okay. Retail sales up 12% last year, also rather slow growth. The growth rate was also quite low. So a lot of the retail stocks in China, even in Hong Kong, Chow Tai Fook, Luk Fook, are not faring very well because of the weakening consumption, weakening spending. We expect this to continue this year, despite rate cuts from the central bank. The spending will continue to be very soft, very weak. And for retailer stocks such as department stores, Parkson, which you may be familiar. We are bearish towards the sector at the moment because first of all the consumer spending is still weakening, and on the other hand competition is very keen among retailers in China, especially from e-commerce. E-commerce are taking business away from the department stores, also from home appliances. If you are familiar with Wong, the share price, and Suling is reporting a loss. Suling is the two largest, used to be the two largest home appliance retailers, chain stores in China. So they are facing fierce competition from e-commerce such as Alibaba and Jingdong, which is listed in the US. So retail stocks, we are not very upbeat about retail stocks this year. Exports up 4.9%. Actually, it has shown some improvement after the sharp drop in mid-year last year. So for export, it depends very much on external demand from the US, from the EU, from ASEAN and Japan. So this year we are expecting China's exports at best, the growth rate would be single digit. It would be between 4 to 5% single digit growth. As for the trading partners of China, US and ASEAN would be more resilient. The demand from US and ASEAN would be more resilient because of their economic growth. But EU and Japan would be quite weak. So for exports will affect, what sector? That would mainly affect the container, the shipping sector. So with a weakening export, container shipping, we don't expect container shipping to do very well this year. Last year, you look at share price of Costco, Zhonghai Xiyuan, CSOL, the share price underperformed the market because of weak demand for container shipping. And this year still we see the peak of new container ships to be delivered, a lot of delivery of new containers. So the growth in the capacity will outpace the growth of demand. So we are still downbeat on container shipping. Imports was down 0.6%, but it's holding quite well because I think compared to container shipping, we are more upbeat on dry bulk. If you really want to go into shipping stocks, I think dry bulk is more resilient. It's a better choice than container shipping because the slump in commodity prices have created demand for iron ore, for coal in China. Despite the economy weakening last year, China's iron ore imports and also coal imports have risen to record high last year because it's so cheap. Iron ore has dropped from about $140 per ton to currently around $60, and we expect further drop in iron ore prices this year because if you analyze the capex plans by the major iron ore producers such as BHP, Billiton, Rio Tinto, and Vale, you can estimate or project more substantial increase in new outputs this year. So if the overcapacity of iron ore will lead to further decline in prices. As for China, there will a lot of new projects have been announced. You know, the new sea route So there will be a lot of infrastructure investment going forward. The demand for iron ore will be still strong. So that would support the dry bulk shipping industry. But we're not recommending it. My point and my stance is if you really want to buy some shipping stocks, better avoid the container shipping, but we prefer the dry bulk shipping stocks. Okay. CPI just now up 2%. So this year we expect CPI to be maybe below 2%, drop below 2%. But that's for the Central Bank of China. That's also a good thing because the Central Bank, if there's need to cut interest rates to stimulate the economy, they have room to cut interest rate further because of weak inflation environment. This is more worrying, the PPI. It was in negative growth region for territory for 35 months. So it was down 35 months consecutively in a row. But it is affected by the drop in oil prices, in commodity prices, iron ore, coal ore, the commodity prices drop, caused the PPI to drop. This is the producer price. If you look at the iron and steel manufacturers in China last year, despite the economy weakening and iron and steel prices still dropping, they posted the best earnings in 3 years, the iron and steel makers. Why? Because the raw material price dropped more quickly than the iron and steel prices. So there's an improvement, a widening of the profit margin. We expect this to continue this year. So iron and steel makers, companies like Angang, Magang, I think the valuation looks quite attractive. The people, they are trading at 0.5%, 0.5 times people. That means if their NAV is $1, they're trading at 50 cents. So deep discount to the NAV because investors are skeptical about, they worry about the iron and steel sector. But I think it's the valuation is attractive because China, they are going forward, as I mentioned, there are still a lot of infrastructure investment that will lead to a lot of strong demand for iron and steel. And then on the other hand, raw material prices keep dropping, so we expect further improvement, further widening of profit margin for the iron and steel makers. Okay. But for coal, we are less optimistic. Coal mining companies. So last year, 中国神华。Zhongmei and also Yanmei, the share price all underperform, all fare very badly because they are facing stiff competition from suppliers from outside China. Now Australia, Indonesia, they are all supplying very cheap coal to China because of the overcapacity in the world coal industry. So for a lot of the industrial users, such as cement manufacturer in China, it's cheaper to import coal rather than to buy from domestic suppliers. So we expect this to continue this year. So the coal mining industry, despite the price have dropped so much, I think the upside is still very limited because of competition from international suppliers. Okay. M2, the money supply grew by 12.2%, a rather low rate last year, and new yuan loans amounted to 9.78 trillion. Now I think the problem for many of the small and mid-cap, medium-sized companies in China is there's new yuan loans, new loan growth. 9.78 trillion loan growth is not small, but the problem is the banks, they are reluctant to lend money to to lend money to small and medium-sized companies, fearing that they are not able to repay the loans. So now you read a lot about small companies in liquidity. There's a credit crunch, a liquidity problem. We don't expect this to improve very quickly because the banks are very risk averse. But going forward with interest rate cuts, it will be favorable to banks. So this year, I will talk later about our outlook of the A-share, but I can share here that we are still bullish on the A-share market. I will explain why. We believe the rally will continue. And for the A-share to continue to rally, I think the financial sector will play a pivotal role to lead the market high. Last year, you noticed the banks, the insurance companies, 中国人寿 all the four state-owned banks, the share prices have risen quite a lot, leading the Shanghai Composite Index. So this year, for the index to move higher, I think the major growth engines would be the banks, the financial. So with for the banks, interest rate, if there's an interest rate cut, it depends on whether it's a symmetrical cut or asymmetrical cut. By symmetrical cut means that the interest rate for deposit rates and lending rates are cut at the same pace. So if that is so, the interest margin of banks will not alter the interest margin. But with interest rate cut, it may spur the demand for loans. So that's why interest rate cuts are favorable to banks, because interest rate cut will stimulate demand for new loans. And then with interest rate cuts, it will also lessen the probability of default, of deterioration in credit, in the credit asset quality. If interest rate very high, many of the borrowers will not be able to repay their debts, and they will result in a lot of non-performing or bad loans. With interest rate cut, it will favor the banks. So this year we think that the mainland commercial banks, the share price will continue to appreciate after the recent consolidation. As for the insurance company, it's a bit more complicated, complex, the impact of the interest rate cut. Because on the one hand, the premium received by the insurance company, most of it are invested in bonds and bank deposits. So rate cuts will affect the earnings of the investment return of insurance company. From that angle, it's not very favorable to life insurance company. But you notice that when there is a rate cut last year, after the rate cut, insurance company also, the share price also rallied. Because I think it's being one of the financial stocks, they will respond positively to rate cuts. And also from the other angle is when interest rates are high, for insurance company, it's very difficult for them to sell their insurance, the investment-linked products, because investors will opt for higher interest rate. They put their money in the bank. So why bother to buy insurance products or investment-linked insurance product? But with interest rate declining, it's easier to sell investment-linked insurance products. So that you'll see a acceleration in the premium received by insurance companies. So rate cut would favor banks and also insurance companies, and also security firms as well. I'll talk about security firms later, because I was just asked what's my view on the mainland Chinese security firms this year. Last year, I think if you have bought CITIC Securities or Haitong, well, the share price fared very well. The share prices have risen very substantially. So what's our view on this sector? I'll talk about it later. every dark cloud has a silver lining. So for China, despite the economy slowing down, we see some silver lining. So here I will highlight to you some of the silver lining in the Chinese economy. Structural adjustment achieves stable progress. By structural adjustment, we look at the structure of the economy, which comprise primary industry, secondary industry, and tertiary industry. By primary industry, we are referring to agriculture. Secondary industry, we refer to manufacturing, and tertiary industry refers to servicing. So the value, the added value of primary industry among the three types of industry is the lowest. Agriculture, is not very of high value, added value. Then last year, the value of the tertiary industry accounted for 48.2% of GDP. So it's accounting for nearly half of the GDP. In the past, China is known for its farming sector. 中国以农立国, so the farmers are very important. But gradually, China has transformed to a manufacturing economy. 中国世界工厂, it has become the world factory. But now it's facing competition from other cheaper regions. So whether you can still maintain the position of world factory is, standing a test. So now China is moving up the value chain. Tertiary industry accounts for a bigger proportion of the GDP. It's 1.3 percentage points higher than last year and 5.6 percentage points higher than the secondary industry. And we expect this to continue. So this year it's very likely that the value of the tertiary industry will account for 50% or even more of the GDP, of China's GDP. Another encouraging point to note is residents' income continues to rise. In 2014, the national per capita disposable income was around 20,000 yuan. So China has, in terms of the GDP, the gross GDP, China has overtaken Japan to be the second largest in the world, just next to the US. But in terms of per capita, China is still the GDP per capita is still quite very low. Disposable income was just 20,000 yuan, but it shows a nominal growth of 10.1%, which is higher than the economic growth. I think this is very important to take note of, is the residents' income. If it is lower than the GDP growth, that would be a problem. That means the money people make will not meet the pace of the economic growth. And the per capita disposable income of urban households grew 9%, whereas the income of rural residents grew 11.2%. So this is also a healthy trend for China. The rural population that we are referring to those living in the rural areas still account for about 45% of the total population. So whether they earn more, if they earn more, that means they have higher spending power, and also their demand for housing, other consumer goods will fuel future economic growth. So rural residents' revenue income grew faster than the urban households. That's a good sign. And the income gap further narrowed. The per capita income of urban households was now 2.7 times of the rural households. So the lower means the gap being narrow. Now it was last year was 0.06 times less than 2013. And the Gini coefficient, which is an indicator of the rich and poverty gap, is stood at 0.469 in China last year. Some improvement compared to 0.473 in 2013, so it was lower than 2013, but still not a healthy level, because the Gini coefficient, by definition, if it's above 0.4, the threshold is 0.4. Above 0.4 means an economy or country whereby the rich and the poor, the gap is very huge. With a huge gap in the rich and the poor, that may result in a lot of social problems, social unrest. So for China, I think we monitor very closely whether this Gini coefficient will continue to come down to the healthy level of 0.4. Okay. Population natural growth rate of 5.21 in 1,000. China has this, has become the world factory because it has the advantage of a young working population. Why China can become a world factory is because it has a lot of cheap labor. But there's the worry that with an aging population, this advantage will gradually diminish. We'll see no more advantage of a young working population. But last year we see natural growth rate of 5.21. By the end of 2014, the total population of mainland China was 1.36 billion, so 13.6万的人口, an increase of 7.1 million over that at the end of 2013. And out of this 7.1 million, you look at the number of births and the number of deaths. Number of births was 16.87 million, and the birth rate was 12.37 in 1,000. You divide 16.87 by 1.36 billion, so the birth rate you got was 12.37. Of course, a lot of people pass away in China, which is double the population in Singapore, you see. The number of deaths in China last year was 9.77 million, with a death rate of 7.16 in 1,000. But you have more babies than people passing away. So there's a natural growth rate of 5.21. You may ask me what's our view. Would that be mean something for the say for instance the dairy product industry? Would that be positive for the dairy product industry and also baby products manufacturing? But which may not be so, because China is opening up the dairy industry, so you notice more competition, foreign competition. Actually, in formula milk powder, now in the first tier city, is already dominated by foreign brands, foreign manufacturers. Of course, China has itself to be blamed. The food safety, the fiasco about the milk powder manufactured by domestic manufacturers caused a lot of health problems. So consumers opt for foreign products which are safer despite being more expensive. So now the formula milk segment is dominated by foreign competitors. Now we are witnessing accelerating competition in another area. There's the UHT milk, 液态奶. UHT milk, they are the major product of Mengniu and Yili. So why with a lot of baby births of newborns, why the share price of Mengniu and Yili are not performing? Because foreign competition is heating up, is getting more and more intense. But China, the supply of raw milk is still insufficient. So if you ask me, the dairy industry, what sector, what stocks we are more we like, we would prefer the upstream companies such as Xiandai, Modern Dairy, 1117, because there's a clear cycle for dairy milk prices. 3 years is a 3-year cycle. 3 years. The price of raw milk is for global raw milk prices. It will top and bottom within a 3-year cycle. So the last peak was 2013. You heard about the Nai Kwang in China. There was insufficient supply of raw milk, caused the raw milk prices to soar. It soared to global raw milk prices soared to $5,000 a ton. It was the highest in 2013. And then subsequently, because the supply increased when prices soar, after prices soar, they use a lot of new entrance to the industry, so it caused supplies to increase, and then with a weakening economy, global economy, demand slackened, so the prices of raw milk tumbled and declined to recent low of $2,400 per ton. So there was also the peak and also the trough seen in the previous 3-year cycle. Now it is rising again because of New Zealand. You heard about the drought in New Zealand, and also a lot of the Chinese dairy cattle farmers, they have either slaughter their dairy cattle because they are losing money producing milk, so they would rather slaughter their cattle or sell their cattle as sell the beef of the cattle. So you can expect in 6 months to 1 year's time, with the decrease of dairy cattle in China, the supply will tighten again, and then you will see again the cycle. We expect this cycle, it bottomed out in 2014. Last year, the raw milk prices dropped to $2,400 a ton. So that was again the trough, the bottom. It bottomed out last year, so it started rising in the second half last year. We expect if this 3-year cycle, under this 3-year cycle, we expect raw milk prices to peak out in 2017. So we are expecting higher raw milk prices. With higher raw milk prices, it will not be favorable to the downstream manufacturers such as Yili and Mengniu, but it will favor the upstream producers such as Xiandai and Wuyie. And Hong Kong, there is another upstream manufacturer called Yuansengtai. Yuansengtai has just released issued a positive profit warning. Its earnings increased by more than 90% last year. So despite the drop in raw milk prices last year, its earnings increased by nearly double last year. So with higher raw milk prices this year and next year, I think our pick in this industry is the upstream operators. Okay. China, there's a lot of talk about urbanization. So urbanization, you look at the figures, is in stable progress. In terms of urban-rural structure, the urban population last year was 749 million, an increase of 18 million. So 18 million more people moved from the rural area to live in the urban area, and the rural population was 618 million, a decrease of 10.95 million. The proportion of urban population to total population was 54.77%. So according to planning by the central government, by 2020 to 2030, this urbanization rate would be expected to increase to 65% to 70%, between 65% to 70% in the next 5 to 10 years, by 2020 to 2030. This urbanization rate will further increase. So what's the implication? The implication is China has to build more transportation, more railways, more highways to link up the rural areas with the urban areas, and there is more demand for housing with more people moving to live in the cities. So the implications for the infrastructure is positive. It's positive for infrastructure. As for building construction material, I think it's a bit mixed, because on the one hand you see continuous demand for more construction material. But on the other hand, it's not that simple. I mean, not all the construction material industry will benefit. You have to look at supply and demand. Say, for instance, cement. The cement industry is still suffering from overcapacity, oversupply. So last year, despite the results posting rather good results by some of the cement manufacturers, An Hui Kan, Huarun, Xihao, China Resource Cement, the share price underperformed. It's because of the worry that oversupply will cause prices, cement prices, to drop further. So this year, I think this oversupply in the cement industry will continue. If you ask me, among the construction material, which sector is better, which industry is better? Just now I mentioned we are more upbeat on the iron and steel because the raw material prices continue to fall and they will lead to better profit margins. And demand will be resilient from all the infrastructure projects in China. Okay. Now with the economy slowing down, so we expect more rate cuts and also more our cuts this year. The PBOC cut benchmark interest rates in November in 2014, first time since July 2012, and also cut the reserve requirement ratio to 19.5% in December. I think for playing the stock market, it has become quite simple in a sense last few years. For markets that you see monetary easing, the market go up. In the US, despite, I mean, the US, the economic growth is not very strong, and corporate earnings are actually, the growth is slowing down. But with the QE, with now the Fed stating that they will be patient, increasing interest rates, so the US stock market can continue to see new record highs. And for Europe, you see, the weak debt problem is still a concern. Yet the DAX, the Frankfurt DAX, the German DAX index has achieved new highs recently. It's all because it's all boils down to quantitative easing, interest rate cuts. So for China, it's a latecomer. China only started to cut interest rate in November last year. So if you ask me what's the outlook this year, I think the answer is quite simple. Will China continue to ease? Will that be the last time, I mean first and also the last rate cut in China? I think definitely the answer is no lah. We expect more rate cuts. So more rate cuts means the rally in China's stock market will continue. I think it's still just taking a pause, and it's a good time for you to go in at the moment. Let me show you the chart again. So it started to rise in July last year, and the rally accelerated in November, sometime in November. I think that coincides with the launch of the Shanghai Hong Kong Stock Connect. So the Shanghai Hong Kong Stock Connect, we mentioned just now what it has achieved. I think what it has achieved is it has helped accelerate the rally of the A-share with the new inflow of international funds, because it coincides with the launch. The launch of the Shanghai Hong Kong Stock Connect was on the 17th of November. So clearly from the chart, you see after the commencement of the Shanghai Hong Kong Stock Connect, the A-share rallied so sharply. And then it rose to 3,400. After the sharp rally, it met resistance at the 4,400. And then there is a pullback, there's a correction. This one we tend to see it as a correction, a consolidation after the sharp rally. And if you look at it, has risen from 2,000 points to 3,400. If it correct by 50%, that means it's up 1,400. If correct by 50%, then it has to correct about 700 points. You're looking at 2,700 as the expected level. But it fails to, find support above 3,000. That means the market is actually still very resilient after the sharp rally in the last quarter, in the fourth quarter 2014. I can be quite sure that after this is a consolidation phase. After the consolidation, it will break above 3,400 and you'll see another rally, another leg up. So now we are, the market is preparing itself for another rally, for another leg up. You are not in the market yet. I think this is, of course, the best time is during the correction down back to 3,000, close to 3,000. Now it's 3,300. So you are 10% higher than the recent low. But if we are expecting higher level, I'll talk about the target this year. So whether it makes sense to enter the market at the present level. Okay. First of all, we mentioned about the property market. So after the relaxation, now you see China actually easing from two fronts. On the monetary side, the PBOC cut interest rates, started to cut interest rates, and also the reserve requirement ratio. On the other hand, they relaxed it. They remove the restriction on the home purchase on the property market. 41 cities in China have relaxed or totally lifted home purchase restrictions last year. The restrictions on the second property and third property that people buy in China. So now only the four first-tier cities, namely Beijing, Shanghai, Shenzhen, and Guangzhou, still have home purchase restrictions. All other cities have actually relaxed or lifted the restrictions. And we are seeing signs of warming up because prices of new homes fell in 64 cities in January. You still see a correction in the property in new home prices in 64 cities. But compared with 65 in December, that means one city less show home prices drop. Prices rose in 2 cities and remained unchanged in 4 in January. And among the 2 cities that show price rise in January, one of the cities is Shenzhen. Shenzhen has always been seen as a barometer for the China property market. So if property prices in Shenzhen drop, very likely the whole country, the property prices will drop nationwide. But now Shenzhen are showing signs of reviving price rebound in Shenzhen. So is China, will the A-share continue to rally? I hope to answer this question using this chart. I think I showed you this chart many times before to illustrate the valuation of the A-share market, whether it's cheap or expensive. So from the 10-year average of the PE, this is a price to earning band. The fair value, we calculate the fair value of the Shanghai Composite Index represented by the blue line. It would be at 15.5 times. So for A-share, the fair value is 15.5 times. Now it's trading around about 11 times. That means it's still below the fair value. Despite the rally last year of more than 50%, A-share is still cheap by this definition. It has been very, very cheap when the PE dropped to below to around 6 times to 7 times. That was very, very cheap. So now there is a value restoration, 补值收复